Let's take a step back and really dig into that housing data that we got this week, because it may not be as bad as those headline numbers show. It's Markets with Megan. This is Thursday, July the 24th. If you like this podcast, please subscribe, hit that alarm bell. You can share it with friends, family, or colleagues. But as we usually do, we're here today to break apart the economic data and what does it mean for the future of the economy. Over the past couple of days, we've received quite a bit of economic data on the housing market for the month of June. And what we saw is that whether you look at sales of existing homes or sales of new homes, both of these miss the expectation for the month. We're all not surprised by this. Housing has continued to be in recession for several years now, given the high interest rate environment. But we also saw the final reading on building permits, which tend to be a leading indicator for the future of the housing market. They actually declined as well. Now, why am I taking a glass half full on this? Because let's look within the underlying fundamentals of housing. And first, let's look at the existing home sales. We saw the month's supply. That's increased now to the highest level since June of 2016. That's good because for so long we didn't have enough houses for sale, and this was causing prices to rise at a level that was filtering into what the Fed looks at in the inflation data. What we saw was that prices, and this is where we get to inflation, prices are growing on an annual basis only 2% now. So those price gains have started to slow down. We saw at the end of 2024 that prices were rising almost 6% on a year-over-year basis. So this is a big deceleration in the increase in housing prices. That could help. This could be the signs of maybe some thawing here in the housing market. When you look at new home sales as well, the headline number was disappointing, but look at the month's supply. It's now at the highest level we've seen since the fourth quarter of 2022. And prices saw their biggest month-over-month drop in 7 months. You're now looking at an existing home sale. That's about a $435,000 for a median price. A new home is actually $402,000. Now, what does this all mean? Let's look at the mortgage rates. Really, the mortgage rates over the past couple months have been stuck. You're looking about 6.8, 6.9% for just that median average rate of a 30-year fixed mortgage rate. Let's remember that's a fixed rate. The average rate, though, that is still significantly higher than what we saw in the 5 years leading up to the pandemic, which is about 5.5%. Again, not surprising. It's dictated by interest rates. So mortgage rates are still high. We understand that that still is a factor of the Fed, but the supply may be showing signs of easing. That's good news for the rise in housing prices because that leads into inflation, and it will be something the Fed's looking at. That's all we have today. We'll be back tomorrow. We'll get that first reading on durable goods orders. That's important because it feeds right into the GDP numbers that we get here for the month of the second quarter, so for the month of June. If you want a further history of our podcast, you can go to marketswithmegan.fm. Thank you so much.